All right, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be showing you the right way to scale up credit spreads and iron condors. And similar to my last video on scaling up short naked option strategies like strangles and naked calls and naked puts, when it comes to credit spreads and iron condors, there are also two different ways you can scale these strategies up, but you must also do so in the correct order. There is a right way to scale up these strategies, and there's also a wrong way. Now, as always, before we get started here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. All right, so now let's dive in here, and what you're seeing is a 1-year price action chart of Plug Power. This is the example stock I'll be using to demonstrate how to scale up credit spreads and iron condors. And just to clarify really quick about what I mean when I say scaling up, I'm simply referring to putting on larger and larger positions that require more and more capital. And so scaling up your strategies, scaling up your position size is something you're going to have to do as your account size also grows. And knowing the proper way to do this is absolutely crucial for your success as a trader. And so now in the case of Plug Power here, since this stock has really sold off in the past few weeks and months, let's just say for the sake of example that I am now bullish on this stock. And as a result, I want to sell a put credit spread below the current stock price, which as of right now is just over 23 bucks per share. So with that in mind, let's come on over to the trade tab now and take a look at the option chain on Plug Power. And we'll go into the June expiration cycle. These options expire in 40 days from today on June 18th. And I'll scroll down just a little bit here. And so let's also say here that I am a new trader and I only have right now a few $1,000s in my account. So that's why for starters, I might want to begin with just $1 wide put credit spreads. So perhaps in this case, I want to sell the 21 strike put option and then also buy the 20 strike put option. Right, this would be a $1 wide put credit spread. So let me go ahead and set up this order. So I'll go to sell and then vertical. And that brings up the order down here. And by default, it already has the strikes that we want right here. I'm going to sell one contract, 21 strike put option, and then also buy one contract, 20 strike put option. And the credit you would receive for putting on this position will be $37. And so this also means your total risk, your max loss on this position is $63, right? To calculate the max loss on a defined risk credit spread or an iron condor, you simply take the width of the strikes, in this case $1, you subtract from that the total credit you receive for putting on the position. So once again, it's 37 cents per share or $37 in total. So $1 minus 37 cents is 63 cents. And then you just multiply that by 100. So 63 cents times 100 is $63. That's the max loss on this position. And so now let's take a look at the probability of making a profit on this trade. So what I'll do here is right click on this order and go to Analyze Trade. And that brings me over to the Analyze tab now. And what you're seeing here is the payoff diagram for that put credit spread, which you can see down here again. Now I do have a separate video explaining exactly how this all works and how to calculate your probability of profit for any options trading strategy, and I'll post a card above linking to it so you can watch it later. So in this video here, I'll just briefly go over how this works, and then if you want to see a much more in-depth demonstration, you can go ahead and watch that other video. So on the x-axis here, we have the price of Plug Power, basically a range of prices where the stock could be by the expiration date, and that's what my cursor here is going to represent. Right, just think of my cursor here as Plug Power moving around in price. And then on the y-axis here, this is my profitability or lack of profitability for this put credit spread based on where Plug Power actually moves around. And specifically this blue line, this blue curve will tell you exactly how much money you expect to make or lose on this put credit spread by the expiration date, by June 18th. And again, that's based on where Plug Power actually ends up by that time. So in the case of our put credit spread down here, because we sold the 21 strike put option and bought the 20 strike put option, that means the best case scenario is both these options expire worthless. And we just keep the full $37 in credit. And the only way that can happen is if Plug Power finishes by the expiration date above $21 per share. And so that's why if I hold my cursor right on $21 per share, and then you go up to the blue line right here, and then finally over to the y-axis, that ends up right on $37 in profit, which is your max profit for any price above my short put strike. So Plug can go to 22, 23, 24, 25. It can go to 500. I'll still make the max profit of $37. And then below 21 bucks per share, if Plug Power finishes below that price by the expiration date, well, the further it falls below 21 bucks per share, the more money I'm going to lose until I hit the max loss scenario of exactly $63. So that's how the diagram works here. And then you'll also notice these brown dashed lines and also these percentages in between them. And these represent the probabilities of Plug Power being within these price ranges. In this case, for this zone, in between the prices of $19.74 and $23.03 by the expiration date, by June 18th. And so specifically between this range, there's about an 18.65% chance that Plug Power will indeed end up within this range by the expiration date. And so now the way I can figure out my probability of making a profit on this trade is by taking note of this red dashed line right here. This red tick is my break-even price, which is right at $20.63. If Plug Power finishes at exactly that price by the expiration date, I will totally break even on this put credit spread. I'll make no money and I'll lose no money. So anywhere above that red tick, I will actually make a profit on this trade. And so I want to figure out the probability of Plug Power simply being above my break-even price, anywhere in this area and beyond. And so what I can do is take this dashed line here and just drag it over onto my break-even point. And now you'll notice these percentages have changed, at least this one and this one. These other two have not changed. So now finally, if I want to figure out the probability of Plug Power being above my break-even price by June 18th, all I have to do is add up these three percentages, right? Because I don't care if Plug Power ends up within this range or that range, because anywhere above this red tick, I will make a profit on the trade, period. So like I said, I just have to add up these three percentages, these three probabilities. So let's get out the calculator here. And so we'll take 13.41%. That's the first percentage, the first probability. We'll add to that 11.07, and then one more time, add to that 32.45%, 32.45. And so there you go. There's a 56.93% chance, or just rounding up, call it a 57% chance that I will walk away with a profit, some profit, on this position. It could be the max profit of $37, or it could just be $1. So now let's say I've been trading for a little while and I've saved up some money that I now want to deposit into my account. And as a result, now that I have more capital, I want to scale up my positions going forward. I can now afford to take on bigger risk than just the $63 max loss scenario for this put credit spread. And therefore, I can now afford to shoot for larger profits as well. So it's time to scale up. Well, let's come back to the trade tab now. And so now, like I mentioned at the beginning of this video, there are two different ways you can scale up defined risk strategies like credit spreads and iron condors. You can either just increase the contract size. So in this case, instead of selling just one put credit spread, I could sell 2 or 3, 4, 5, any amount that I want. And therefore, I would just multiply the total credit I would receive and also the max loss scenario by the number of contracts that I'm selling here. So in this case, pulling up the calculator again, if I were to now sell 5 of these $1 wide put credit spreads, I would just take the credit per spread and multiply that by 5. So now my total credit on this position would be $185. And then also, like I said, you have to multiply your max loss by the number of contracts you're selling. So the max loss per spread here is still the same $63, but now multiply that by 5, and my max loss turns into $315. Now there's nothing immediately apparent that is wrong with this approach, right? I'm taking on bigger risk to make bigger profits. That's how it works. But under the hood, there is a significant issue, and that is my probability of profit is still completely unchanged, right? Again, if I right click on this order and then go to Analyze Trade again, and let me close this, and also let me uncheck the first order here. I just want to show the diagram here for this new order with 5 contracts on the same $1 wide spread. And so like I said, the probability of profit is still exactly the same, right? 13.41%. I know it's a bit hard to read here, but 13.41% plus 11.07 plus 32.45 is still 56.93%. Nothing has changed. So this, in my eyes, is the wrong thing to do when first starting to scale up your credit spreads and iron condors. There is a better way to do this. So let's come back to the trade tab. And now I'll reduce the contract size back down to 1. And instead, I'm going to increase the width of the spread here. So we're still going to sell the 21 strike put option, but now for the option we're buying, we're going to purchase the 16 strike put option. So now the spread is $5 wide. And as a result, the credit received will jump significantly. For this one spread, we'll take in $126, which means the max loss is going to be, again, take the width of the strikes, $5. Subtract from that the credit received on a per share basis, so $1.26. That gives you $3.74, and then finally multiply that by 100. So the max loss scenario on this put credit spread is $374, which is not that much greater than selling 5 put credit spreads that are only $1 wide each. So in terms of risk to reward, this is a very similar setup, a very similar position to selling 5 tranches of a $1 wide spread. But here's the main difference. Now if I go to Analyze Trade on this one, and let me exit out of this and uncheck this, right? So now we're looking at the payoff diagram for only the $5 wide put credit spread. And you should notice that the red tick, the break-even point, has moved further to the left, which means Plug Power can move even further to the downside and will still at least break even or make a very small profit on this trade. So to calculate the probability of making a profit on this trade, I have to click and drag this dashed line and move it over to the left. And in doing so, that has changed the probabilities here, right? Obviously with a greater range in this case, then the chance that Plug Power could end up within this range is obviously going to be greater. So just like before, we now have to add up these 3 probabilities. So first we'll take 18.65, add to that 11.07, that hasn't changed, 11.07, and then finally add to that 32.46. So the chance that this position is going to turn a profit is now 62.18%, which is over 5% more than selling 5 rounds of that $1 wide spread. So even though your risk to reward on this trade, this $5 wide spread, is pretty much the same, it's very close to the 5 tranches of that $1 wide spread, you actually still in this case have a higher probability of making a profit. So why, in regards to these 5 tranches of the $1 wide spread, why would you risk the same amount of money for a lower chance of success? It does not make any sense. So this is why when you are trying to scale up your credit spreads and iron condors, you should always start first by increasing the width of the spreads, because doing so will increase your probability of making a profit for no additional cost. And also that reminds me, when you think about commissions for putting on these trades, selling 5 tranches of a $1 wide spread here is going to cost a lot more in commissions too than just a one tranche of a $5 wide spread. So that's also something you want to keep in mind as well. And then after you have increased the width of your spreads to a satisfactory point, and ideally if you ask me, I would just keep increasing the width of the spreads until you just get to a naked option, a naked put in this case. But if you did want to stick with defined risk strategies for whatever reason, maybe you want to have that protection, or perhaps you're trading in an IRA account and you can't do naked options, uncovered naked options that is, then once you have increased the width of your spreads to a sufficient amount that you're comfortable with, then at that point, you can start increasing the number of contracts. then sell 2 spreads or 3 or 4, etc. Increase spread width first, then increase the number of contracts, not the other way around. And finally here, before wrapping up, coming back to the trade tab, I know in this video I only showed a concrete example with this put credit spread, and that's just because I don't want this video going too long. But everything I have said in this video can be applied directly, and I mean directly over to call credit spreads and also iron condors, right? They all work in a very, very similar way. They're just different in their directional bias. Put credit spreads are bullish, call credit spreads are bearish, iron condors are neutral. But otherwise, they function in pretty much the exact same way. So when you want to scale up your call credit spreads or your iron condors, again, start by increasing the width of the spreads to again increase your chance of profit. And then after that point, then start increasing the number of contracts. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.